What's going on, everyone? Welcome back to the Aerial Effects Wealth Accumulation Series, Part 1, Lesson 3. And I hope you've enjoyed the prior two episodes as a general overview of the topic of wealth accumulation. This final lesson in Part 1 is going to also be somewhat of an overview because I want to encapsulate and make sure we understand the macro and understand the broader perspective and mindset that's going to be necessary before we get into some more of the specifics. Okay? So make sure you take out kind of your notepad and sit back and really kind of reflect on what we're talking about here because this is an overview. Okay? We need to make sure we understand the outline before we get into the nitty gritty. Okay, and so this one's going to be talking about asset accumulation. All right, and obviously in the last lesson we talked about working a job and how it's not necessarily a bad thing as long as we have that proper mindset. And part of that is understanding the difference between assets and liabilities. And wealthy people, a big difference between wealthy and poor people is simply understanding the difference between what is an asset and what is a liability. Okay? Poor people, or those trapped in the lower middle class, don't understand assets. Okay? They take earned income and immediately purchase liabilities, right? Things that are going to take money out of their pocket. Okay, and we kind of touched upon this in our prior lessons. Okay, but again, we really need to emphasize, and if you don't understand the simple difference between assets and liabilities, and the way I like to put it is it putting money in your pocket or taking money out of your pocket? But if you don't understand or want to get a further knowledge in the topic, I highly recommend reading Robert Kiyosaki's series, okay, starting with Rich Dad, Poor Dad, if you haven't already, okay? But we really, really need to understand that assets are what's going to put money into our pocket. Maybe not now, okay, and that's where, instant gratification comes in. So many people purchase liabilities because it gives them that instant gratification. Oh, I'm going to go buy a new pair of shoes, or oh, I'm going to buy this and that, okay, and that's not going to put money in your pocket. It's going to take money out. Okay, so why do we want to accumulate assets? Okay, this video is on asset accumulation. Why do we want to do that? Okay, because we want to have multiple streams of income. Okay, we want to be able to put our money to work for us because our money can work a lot harder than we can and doesn't require PTO, doesn't only work 8 hours a day. Okay, your money can be working for you all day, every day. Okay, and a lot harder. And that's where we understand the velocity of money and the power of compounding. Okay, so we want to accumulate assets because we understand that those assets down the road, okay, are going to provide streams of income for us. And remember, what is the ultimate goal here that we talked about in lesson 1? Okay, it's financial freedom. Okay? And so what is financial freedom? Again, another way to look at it. Financial freedom is when your assets, cash flow from assets, exceed living expenses. Okay? And so with that in mind, okay, we have to have somewhat of a long-term perspective. Okay, this isn't a series to pitch you on getting rich quick. I promise you, it's unless you start some type of crazy tech business or just hit it lucky in the markets, you're not going to get rich overnight. Okay, this is a tried and true but steady approach, and to the point where you're not going to need to work until you're 65 and crippled. Okay? This is not a get rich quick scheme, but if you follow the principles in it, it is the most tried and true way to quickly amass a large sum of wealth. Okay? So we really need to sit back and relax and understand that this is going to take some time. Okay? Some time. Okay? We need to understand risk versus reward. Okay? Especially the younger people watching this video. Okay? If you aren't taking at least 30% of your earned income and putting that back into assets off the top of your paycheck or your earned income, whatever that might be, your steady, your typical income, and you aren't reinvesting that or putting that into assets off the top, you're already falling behind. Okay, the younger you are, the more aggressive you need to be in accumulating assets. I understand if you're older and you already have, a wife and kids and a house and all of that. You have to take that into consideration. Obviously, it doesn't mean you still shouldn't be aggressive. Okay, maybe you can dial it back a little bit, but especially if you're very young, in your 20s or even 30s, you should really, really be heavily investing a large portion of your earned income. Okay, and so the simple formula, and I'll give credit to one of Robert Kiyosaki's close advisors. He's Robert Kiyosaki's CPA. I highly recommend his book. It's called Tax-Free Wealth by Tom Wheelwright. And the simple formula is start with earned income. Invest heavily in growth assets. Create a huge amount of capital from your growth assets, and then invest in assets that generate passive income. With a substantial amount of capital, even investments with modest returns result in massive passive income. Okay, and so what I'm telling you right now is obviously cash flow exceeding living expenses is the ultimate goal. Okay, but you're not going to really make much cash flow. Okay, let's say you only have $1,000 or $5,000 or $10,000, even $10,000. You're not going to make much cash flow off of that amount of money, right? But you would if you had 100,000, 250,000. Okay, and so the idea is in the short term, a little bit into the medium term, we need to invest heavily in assets that are going to significantly grow our wealth. Okay, and this is where it differs from what we talked about in a previous video. Most people just invest in their net worth so that they can retire at 65 with a nest egg to then live off of. No, that's not what we're doing. What I would recommend is investing heavily in assets that are going to compound and grow your wealth. Okay, and it could be a cash flow, an asset that cash flows very nicely, but instead of taking that cash flow out, you reinvest that cash flow, right? The idea is to grow our capital, okay, to a point where the cash flow from those assets, then we can take the cash flow out to cover those living expenses. Okay, hopefully that makes sense. But I'm not going to recommend, putting $1,000 in and you get a cash flow of, $20 a month. That doesn't really do much, right? It doesn't really cover your living expenses. Okay, so the idea is in the short term, go hard on wealth accumulation, essentially net worth accumulation, appreciation assets, so that we then have that lump sum of money that will then provide the steady cash flow that covers our living expenses each month. Okay, that's the ultimate goal. So homework before our next video, and I promise this is the last video of part one. I promise in the next part two, we're going to get into some specifics and some blueprints for you, so you don't feel lost and don't know where to start. Okay, but we really need to again nail all of this down and understand the mindset, understand the perspective before we get into those specifics. Can't stress that enough. Okay, so your homework. I want you to write down and reflect on what your living expenses are now and what they will be in the next 10, 20, even 30 years. Depends on your age, right? Okay, you also have to consider inflation. Okay, so inflation's at like 8% this year in the US. Okay, so that's a factor. If your living expenses are, $1,000 a month, just for example purposes, and you got 8% inflation, okay, well, your living expenses are $1,080 next year, right? Because of inflation. So you have to understand that, and there's websites out there that can help you do this. But I want you to understand what are your living expenses. Okay, what is necessary in order for you to pay your bills and survive. Now, I'm not talking about gratuitous liabilities. Okay, these are the necessities. Okay, and with that in mind, we need to then understand. Okay, when your cash flow does exceed those living expenses, you are technically financially free. Okay, but I want us to get to a point to where our cash flow is at least 1.5x living expenses. Preferably, I meant to put preferably here. Preferably 2x, okay, in monthly cash flow from assets. Okay, so if you, let's say, you want 10,000 a month, you need 10,000 a month for your living expenses. I want us to get to a point and invest heavy in these growth assets to compound our wealth to the point where then we can take the cash flow out from the lump sum, from the ROI on the lump sum, that is at least 15,000 a month, preferably 20,000. Okay. If we need 10,000 a month as our living expenses, we need to make sure we get to a point where we're cash flowing 15,000, at least 20, or at least 15,000, preferably 20,000. Okay. And that's just so that, okay, we have to spend 10,000 a month for living. That gives us an extra 5,000 left over as a buffer, just in case, we have more expenses that month. If not, reinvest it in the principal. Okay, reinvest that extra 5,000 back into the asset that is cash flowing you. What does that mean? That equates to eventually more cash flow. Okay, but that's where it helps. So where it's not, we're just cash flowing exactly what we need for living expenses. That's kind of living on the edge. Okay, we want to surpass that threshold. Okay, so I want you to do some deep reflections, even budget out. Do a budget for yourself if you haven't already. Understand what it really costs you for living expenses. Okay, what it might cost you 10, 20 years down the road when you intend to be financially free. Okay, we really have to have numbers in mind so that we know what we're shooting for. So we have a goal that we can reach. Okay, so do your homework, have a number in mind. Okay, and then in the next lesson, we will start talking about specific strategies to help you get there. Okay, the wait is essentially almost over, but again, go over the last 3 videos, including this one, and make sure you understand the mindset, make sure you understand the strategy, the overarching strategy, and then we'll start getting into the specifics. All right, so I hope you enjoyed this video. Lots of value, guys. This is, I don't have to do this. This is completely free. I just want to help. I want to see, especially, the Forex traders, this niche. Okay, I want to see more people thriving in this niche. Okay, it's much needed. Not a lot of people do things like this. All right, so I hope you enjoyed it. Take your notes, and we will see you in the next video.